You're about to listen to the Yet Another Value podcast. Today is my monthly ramblings for the month of July. We're going to talk with some quick stock market thoughts on what has been just called to me the casino market. I think that's really apt. I'm going to talk some of my thoughts about the stock market and opportunities, risks, dangers, parallels. Following up on that, we're going to talk pattern recognition. When is it a benefit to you as an investor? When can it be a hindrance? When can it be stubbornness? When can it hold you back, prevent you from opportunities, keep you from taking risks, all that sort of stuff. Wrap it up with a quick thoughts on management arrogance, and then a little bit on why I do this, and just tell you, look, I do it because I enjoy it, but I also do it because I get great feedbacks and great thoughts from my listeners. So if anything you hear strikes your fancy, you'd like to talk, reach out. Would love to chat about it. That's it. That's what we're going to talk about today. But first, a word from our sponsors.
Today's podcast is sponsored by Dalupa. Are you still manually updating your financial models after earnings? Ask yourself, why? Every quarter, analysts lose hours copying numbers from filings, adjusting templates, and double-checking for errors. It's tedious, it's time-consuming, and it's a terrible use of your time. Dalupa changes that. They automate your model updates with near real-time precision, using AI that's been trained on thousands of companies' filings across every sector. The result? You get a fully updated model in your format with your logic faster than ever before. Every KPI, every footnote, every guidance figure, exactly where you need it with source links built in. So stop wasting time on data entry and start focusing on what really matters: analysis, insights, and alpha generation. Dalupa doesn't just save your time, it gives you time back where it matters most. Book a demo with the Dalupa team today at dalupa.com/demo. That's Dalupa, DALOOPA.com/demo.
All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to this podcast. Really helps, gets the flywheel going to get a lot of reviews, ratings, and all that sort of stuff out there. It is Sunday, July 20th. Today, I'm coming to you with my monthly random ramblings for July. Before we get there, disclaimer, remind everyone nothing on this podcast is investing advice. Full disclaimer all the way at the end. But, here, I'll also disclaim this, one reason you shouldn't listen to anything I say, this is the July monthly random ramblings, but it's largely going to be topics I touched on in June because I forgot to I pressed the record button. I didn't have my microphone on when I recorded my June random rambling. So there's just 30 minutes of me waving my arms like crazy. So if I'm a semi-professional podcaster and I can't remember to turn my microphone on, should you listen to me about anything? Probably not. So anyway, today, July 20th, got some thoughts. I want to start with some quick thoughts just on the stock market in general. Then I'm largely going to talk about pattern recognition and danger, upsides, downsides of having invested for a while, developing patterns to recognize all that type of stuff. And then I want to move on to a little bit of management arrogance, and then we'll wrap it up, call it a day. All right, so quick market thoughts. Again, it is July 20th as I record this. I've been saying on the blog and my state of the markets that I do every month on the blog, yetanothervalueblog.com. What a great blog. You should check it out. Someone called this a casino market, and it really feels like that to me. It feels very apt. Every day you'll see another 2 to 3 companies that announce some type of Bitcoin or crypto treasury deals, and the stocks instantly trade up 100, 200, 300% to trade for, multiples of the NAV. And it's weird to me, I think Matt Levine keeps saying, hey, a Bitcoin is worth 1 Bitcoin if you own it, but if you put it into a public stock market wrapper, it's worth somewhere between 1.5 to 3 times Bitcoin. It's kind of crazy. There's no other thing that you could do that for. You can go buy Bitcoin on your own. Now, I could understand years ago when it was like, hey, you can't buy Bitcoin on the stock market. Maybe a company that offers access to Bitcoin, whether directly or indirectly, trades at a premium so people can bet on Bitcoin. But today, there's no other, crypto is not unique. Closed-end funds, right? Hey, you can go buy a basket of stocks in a closed-end fund. They trade at a discount because it's an illiquid way. There are management fees and everything associated with oil. There's no public company that says, or, uranium. There were public company uranium ETFs. It's very difficult to get direct access to uranium if you're an investor. These things don't tend to trade at premiums to NAV because something that you can go buy on your own should not trade at a premium to NAV just because it's put into a stock ticker. In fact, it should probably trade at a discount once you think about kind of fees and the risks and all that sort of stuff. I'm not saying it should, but a big premium to NAV is crazy. And all these companies have found what seems to be an infinite money hack. You announce you're doing a Bitcoin treasury, your stock goes to 2x NAV, you keep issuing stock to buy more of it, and you keep growing. It's crazy. It seems very bubbleacious. I think there are historical precedents for bubbles like this. And And honestly, if you put a gun to my head, it would feel medium innings. But that's just Bitcoin Treasury. There are plenty of other places. I'd point to Circle, popular Bitcoin stablecoin company. IPO's at $31 in early June. By the end of the month, it's trading at 83. I'm not sure where it's trading right now, but it's huge premium to the IPO price. It doubled on its first day. When you're talking, oh my God, it's way, way up. It's at 223 right now. When you're talking about stocks, doubling their first day, almost 10xing inside of a month and a half of IPOing, not that one stock is indicative of a bubble, but when you're talking about a lot of growth techie stocks doing that, very dot-com bubble reminiscent to me. CoreWeave would be another. They lowered their IPO price, could barely get their IPO done in kind of late March, early April, barely get their IPO done. They had to cut the price, cut how many shares they're offering. NVIDIA had to anchor it. Stocks casually a 3, 4, 5 bagger since then in 3 to 4 months. So, they go public and all of a sudden there's low flow dynamics. I get all of that, but all of a sudden it's memeing. Oh, Circle. One other story I forgot. There was a day, June 23rd is the day. It opens at 240. It peaks at $300 per share and it finishes at 260. It closes the week trading at 180. So intraday, it swings $60 per share. That's double its IPO price. Intra-week, it swings $120 per share. That's 4x IPO price. Like, these things are crazy. And and again, I'm not making a valuation call on any specific company. I'm just saying when you look at the whole basket of what's happening to Bitcoin treasuries, what's happening with AI, you look at it and say, hey, the casino market, it feels very much like the dot-com bubble. We're obviously having lots of throwbacks to the kind of growth speculative rampage of late 2020, early 2021. It feels very reminiscent of that. If you had to ask me, I'd say we're in the medium stages because things feel crazy, but things always get a lot crazier before they get more rational. But I'm not a market prognosticator. I don't know. I would just tell you two things. Number one, there was, and I try very hard not to bring politics into this podcast or anything I do in investing. I hope I'm not doing here. But there was a day when Elon Musk and Donald Trump were having that big fallout where Elon said Trump was on the Epstein list and Tesla stock was down like 20% a day. And that kind of made sense, right? Like, you had Tesla, all the government contracts, the government might bring the weight of their force against Tesla. It made sense for that stock to be down. But every meme and growth stock was down at the same time. Bitcoin was down like 3%. I think, if I remember correctly, Coinbase was down 7%. Palantir was down 10%. And I understand there's meme factors at work here. There's a hidden meme factor for all the factors and stuff. But when I saw Tesla kind of down and every meme, growthy, parabolic stock was down in sympathy, it made me wonder if there's a lot more leverage in the system than I've been thinking about. So that's one thing I've just had the back of my mind, like, hey, maybe these things are more interconnected than you think. And if that's true, like, the highs can go a lot higher as, you think back to something like who was the firm? I can't remember the firm's name, that they were basically YOLOing CBS/Paramount and a handful of other companies, and they just kept buying. And it was Bill Swing, I can't remember. But when they eventually pulled, all of these stocks completely collapsed, right? And if what I saw on that one day is reminiscent of what's going on here, there might be a lot more hidden leverage, and you can blow things a lot bigger when there's that hidden leverage, and they can fall apart a lot faster once it stops. So that's one stop. The other thing, look, I put a post earlier this week. I do think if we're going to get a full on manic market, and it feels like we're entering that if we haven't hit it already, I personally think, and I've been thinking this for a while, but it's really starting to play out. I wish I'd swung at it harder. I think we could very much have a SPAC bubble here. You're already seeing some signs of it. There have been multiple SPACs that have really gotten buzzy, announced deals, traded up for huge multiples. I think the one I would point everyone to is CEP, which was now the Secretary of Commerce, Cantor, his company. It was their first SPAC. They announced a deal to become a Bitcoin treasury company, and the stock went up 3x. There have been a few others of those. So we're starting to see some signs of Bitcoin, of a SPAC bubble. But I think if the markets get much more manic, we could really see one. And one thing I really like about SPACs, and this is what I put in the piece, you should go read the piece. One thing I like about SPACs, if you're buying SPACs around trust, and I'm right, and you get a Bitcoin bubble, or sorry, a SPAC bubble, you're going to have this call option that is built in SPACs. It's really going to pay off in spades. And if I'm wrong, and look, maybe I'm wrong, I will tell you, I put this piece up in the next day, Friday, July 18th. The air came out of a lot of these things. So I was like, oh, maybe I personally marked the top. So maybe I marked the top, maybe I didn't. But the nice thing is, if the SPAC bubble, if the market falls apart and you're buying SPACs at trust, then you're just going to get your trust back and you basically had a cash equivalent. So I really like them. I've gotten a lot of inbounds on that. I'm going to keep discussing it and keep thinking about, but that's one thing I really like on a heads I win, tails I don't lose thing. If markets keep going parabolic, as a value investor, if you're sticking with your stuff, you're going to be really sad as you see, the core wages of the world go from 40 to 120 to 480. It's going to be really tough to see that. And that's where you see a lot of people like kind of tossing the towel and go manic right at the late stages. That'll be tough. And if the market falls apart, it's going to be tough. I think SPACs offer a nice kind of, I can get some upside, but I've got a lot of protection. So that's what is on my mind for the markets. Let's go to pattern recognition danger. I think pattern recognition speaks nicely. I just said, hey, and it transitions nicely from what I was just talking about. I just said, hey, in the market today, I'm seeing signs of the dot-com bubble. I'm seeing signs of what happened in kind of late 2020, early 2020. That's pattern recognition. And that's on a large scale, and I'm not claiming to be unique with those insights. But I think one of the reasons that people tend to get better at investing as they get older is they develop a really innate feel and for a lot of patterns. And I would point to, I did a post on Warren Buffett's longevity a while back. I might do a follow-up rant on that. But, I think Buffett's a nice example. You can find so many of them throughout his career, but I would just point out how he did during the GFC. He did well, not fantastic, but he did very well during the GFC. Obviously, he handled it a lot better than most money managers. I think he could have handled it better with some exceptions, but he came off pretty well through that. But why did he well during the GFC? Well, part of it is Warren Buffett is a god among men, the greatest investor of all time, all that sort of stuff. But I think a large part is he had a lot of pattern recognition to fall back on. Buffett was investing during the savings and loan crisis of the kind of early 90s. So the GFC was 15 to 20 years later. There are a lot of money managers who were younger than him who were either in analyst roles or weren't investing during the savings and loans crisis. So they didn't have that to fall back on. Buffett did. He understood how things could flow through the system. And there were a lot of parallels there. The other reason I would say is Buffett took over Salomon Brothers and he was the chairman, and he saw how when a bank faced a run, I think he saw the inner workings of what a bank run looked like and how quickly it could cascade and how quickly it could threaten the rest of the system. And I think because Buffett, he personally had that experience, and I don't think any other investors really did. I think he had a lot of that experience to fall back on, to think about when he was putting capital to work, how the market overall would respond, all that sort of stuff. So that's a unique example from the GOAT, but the pattern recognition is something that's a really powerful tool. You talk to investors who've been doing it a while, and you mention something and they say, oh, that reminds me of this stock that was a big winner, or this stock that I missed that was a big winner. I need to take a serious look at this. Or you pitch them something like, oh, I had a big loser that had that risk. Like, this is a real concern. And I'm not saying that makes or breaks a thesis, but it's something that's really useful, that really triggers them. But I do wonder, so pattern recognition is a huge tool for investors. I do wonder when pattern recognition can become stubbornness and can become a hindrance to your investing. And I'll point to a few examples. Let me start by pointing to something me personally, because I like to start with my personal things. There are two places where I would point to my personal thing with pattern recognition, and I'm not sure if it helps or hurts me. There are things that I instantly say no to, and I think most investors have these. But for me, if you bring me something that trades in China, it is an instant no for me. And why is that? Because I saw all the frauds in China in the early to mid 2000s and 2010s. And I also think that there are serious tail risks with investing in Chinese domiciled companies, the assets over there, the structure and everything. I think there are serious tail risks that I'm not willing to underwrite. That's a pattern recognition thing, right? There's a tail risk there, and there's a history of some fraud, and I'm not accusing all of them, but look at Alibaba. There is political risk there where the government decides they don't like the founder, they don't like the company, boom, the company's stock is in the tank. I wonder when I'm instantly saying no to something, Is that pattern recognition? Is that stubbornness? Is that laziness on my end? I'm not, I honestly don't know, but it's something I've thought about with that pattern recognition. Are you cutting off too much of the world or certain subsects of the market? Is that a good thing? Is that a bad thing? Are you staying within your circle? Are you refusing to expand your circle? Are you being lazy? I don't know. The other thing, and again, I will point to me specifically on this, if you've been burned on investing in a certain sector before, and then someone brings a similar sector, you invested in an oil and gas company off the Gulf of Mexico. They drilled a well, it came up completely dry, and the stock went to zero. You're going to be really hesitant to invest in the next company in that sector, right? And I wonder if that's a good or bad thing. I've been talking to some friends about some different sectors where I have prior experience. Here's a great example I'm doing off the top of my head. Talon Energy, the ticker is TLN. The stock's basically a 10-bagger from when it emerged from bankruptcy. It emerged from bankruptcy, and I had a lot of veteran friends who called me up and said, hey, you got to take a look at this. Great backers, really good assets. The puck's going to where they're kind of where the puck's going in terms of power demand. Now, I don't think anyone saw like this much AI power demand, but tons of people were hitting me up on this. And I looked at it, and I have some history with utilities. I said, utilities, like these are commodity businesses. And when they work, they can work, but these are a lot more complex. This is an IPP, independent power producer. It's a commodity business, and it's not in a regulated market. It's in a deregulated market. And I said, hey, when these work, they can really work, but there's lots of interconnected parts, and one small part of this can break, and it breaks the whole thing. And like every 5 to 7 years, basically every independent power producer ends up in bankruptcy. Talon's emerging from bankruptcy. All these things end up in bankruptcies every 5 to 7 years. I was like, look, it sounds like a good thesis, but I've got this prior history with it. It's a pass for me. Shame on me. The thing's a 10-bagger. So I do wonder when that pattern recognition, there's a few other industries where I've seen, been around them a while, and I've seen some risks, and it makes me hesitant to invest in things, or it makes maybe the bar too high for me to invest in things. I don't know. I wonder if that pattern recognition, is that helping me? Is Talon the example that proves the rule? Were there unique risks there where maybe the tailwinds or the market we were in or something overruled it? Or was it a good investment? I'm not sure, but it's something I think a lot about with the pattern recognition. To apply this to other people, there are a lot of investors I'll talk to, and I'm sure people can think about whoever they want to think about. I'm sure I'm not thinking about the exact people you're thinking of, but there are a lot of investors I'll talk to who've been doing this for 30 years. And to make this just like way over the top, their returns the past 10 years have been awful. Every market is racing and they're delivering 0% returns, but they've still got a great track record because they probably smashed the indices from like 2000 to 2005 on the heels of the dot-com bubble, when anything value was just skyrocketing and everything else was falling apart. And you ask them, when I talk to them sometimes, you'll ask them about a company. And, let's say I ask them about Talon, right? Talon, which is a nuclear energy producer. And I'll ask them, they say, oh, that's interesting. It reminds me of this tiny company I bought in 1999 when the dot-com bubble was peaking. And 2 years later, it got taken out as a 5-bagger. You'd be like, hey, that's cool. That has nothing to do with the company I'm talking about. And you wonder, they're trying to apply a pattern too broadly, and they've kind of become stuck in their ways. And I wonder, with pattern recognition, like, hey, the pattern recognition is great, but to go back to the point on stubbornness, can you be too wedded to the patterns? Can the pattern overwhelm all your other thinking to this extreme example I'm talking about, where you look at everything through the light of the winners you had 30 years ago and kind of ignore how the markets have been trending? And let me apply this to an example. To go back to Buffett, when he's underperforming during the dot-com bubble, he writes a very honest letter that says, hey, we're underperforming, but we won't switch from a strategy I understand, and let's just broadly call that value investing. We won't switch from a strategy I understand to one that I don't, and let's just broadly call that YOLOing dot-com IPOs. We won't switch from one that's made us money to one I understand to one I don't. You look at that and you can say, hey, that's what you want, right? You want somebody dedicated to their conviction, dedicated to their ideals, and that would be great. But if I took that and I applied it, in the 2010s, look, Buffett buys Apple in 2017, 2018, after saying for years, I don't do tech, all this sort of stuff. Buffett wasn't willing to evolve with the time. And you wonder, there are a lot of those investors I was talking about earlier who've been doing this for 30 years and their returns the past 10 years have stopped. And why have they sucked? It's in part because they said, hey, I only buy things at 3 times price to earnings. Like, cool. The stuff at 3 times price to earnings now, like those quantitative screens don't really work. They're picked over by computers. They're picked over. Stuff generally trades at 3 times price to earnings for a reason. That's not to say you can't make money buying stuff at 3 times price to earnings. But if that is the whole reason you're buying something, you're probably going to get beaten. Now, if you look at something and you do work on all the stuff that trades for 3 times price to earnings, and you find one that you think is kind of the gem in the rough for X, Y, Z reason, that's a thesis. But saying I only buy stuff at 3 times price to earnings has been, it's been a recipe for getting your face ripped off the past 10 years. Like, I kind of look, and I think with Facebook in particular, I was too wedded to, I saw the mode. I remember when they bought Instagram, I saw, hey, people are making fun of them for spending $1 billion for a company with zero revenue. I saw that was going to be a category killer. I never really bought the stock. And I look at it and say, hey, Andrew, you were probably too married to, you need to buy stuff at 10 times price to earnings. And I think there were other things, but there's a lot of examples of that. But it's just one thing where pattern recognition, having stubbornness, sticking to your things. I don't know. Oh, one more example I'll give. Look, for 100 years, if your family was the local newspaper owner, you were probably the richest family in that city, one of the richest, right? And that was great. And you would have people, it basically gets passed down from father to son or father to daughter, whatever, through the family, and you were the richest person. And that worked. And everybody said, just own the newspaper and we've got a license to print money, basically. And that worked until it didn't, when the dot-com bubble came around, when the internet came around. And if you were a family who recognized that it wasn't going to work anymore, you sold, and you still have your family fortune. And if you're a family who said this newspaper's been in the family for years, for decades, it's always in a license to print money, we're going to weather this storm and we'll come out stronger on the other side, you probably lost most of your family fortune. And there was a pattern of hold the newspaper, but you need to not be stubborn and recognize that. And I think about that with a lot of things. Buffett's got the famous joke about oil rights, or I can't remember if it's Buffett or Munger. What does the Texas oil man say to his grandchildren on his deathbed? Whatever you do, don't sell the oil rights. And for the past 100 years, that's been the right move. At some point in the next, from now until the heat death of the universe, that's going to be the wrong move, probably. We'll probably wean off of that at some point, or oil will get so cheap that there's no real value in those oil rights. Or you could imagine a lot of things, but I think about that. Hey, the pattern recognition, the rules that you've always followed, they make a lot of money, but when is following them a good idea? When is that being a smart investor versus when is it stubbornness? When is it leading you to take tail risks that you don't need to take? I don't know. I did a post on Tibbs firing a few months ago. I won't belabor it here, but Tibbs, he was the New York Knicks coach. He was very stuck in his ways, and he got fired in large part because of that. And you look at that and you say, hey, he's one of the winningest coaches of all time. He stuck with his system. His system made him one of the winningest coaches of all time. But as critics would say, he wouldn't adapt from his system. And I see a lot of parallels there. And I honestly don't know what the right answer is. Last thing I want to talk about real quickly. I talk to a lot of management teams. Every now and then I'll talk to a management team, a CEO, a chairman, whoever. And when you talk to them, they'll say, hey, I am the father of this industry, right? Talk to Thomas Watson about electricity. I am the father of this industry. Edison about the telephone. I am the father of this industry. And sometimes they're right. If you talk to Watson or Edison, they're right. Sometimes they're arrogant, right? Maybe they were at the company that was the father of this. Maybe they were involved. Sometimes I've seen a few managers who like to say, I'm the father of this industry, and I'm not even sure if they were there for the industry's founding or if they know what they're doing. None of that matters. But when a CEO says, I'm the father of this industry, it indicates at least a little arrogance, right? But I always wonder, is that good or bad? I think I tend to lean bad, because whenever I've heard a CEO say, I'm the father of this industry, the subtext is, you little money manager who runs a silly podcast and is talking to me, you have no clue what I'm doing. You have no clue about this industry. I will forget more during this conversation about the industry than you'll ever know. And maybe they're right, but I'm often talking to them because there's a capital allocation problem, or there's something else that maybe it relates to the industry, maybe it doesn't, but it's more my wheelhouse than theirs, and I'm kind of getting dismissed. So I never know. When I talk to another investor, and they're like, "Oh my gosh, we're investing in this company, and their chairman is the father of this industry." It always sounds great, but I never know if, hey, is that indicating arrogance where they won't listen to you? Is that indicating a management team who's going to feel like they should get all the value from the company because they're the father of the industry. All the value the company creates the company industry creates should belong to them. That often goes along with arrogance, right? So management arrogance is just something I've been thinking about, speculating on, all that sort of stuff. Yeah, let's see. I think we're coming up at the end. I really need to start timing these when I record. I guess the last thing I wanted to mention, people ask me all the time, hey, Andrew, why do you do these ramblings? They're kind of silly. Look, the main reason is I enjoy it. I like listening to myself talk, I guess. But sorry, that is not the main reason. I do enjoy it. That's one. But one of the main reasons I do it, and one of the main reasons I enjoy it so much, is the feedback I get. I get so much feedback. I get so much discussion, so many talking points from it. I think it helps me improve as an investor, helps me to talk to people, reach out to people, all that sort of stuff. All this to say is this: I do it because I enjoy it, but I do it because of the discussions I generate. So if you're listening to this and you've got thoughts, I just ended it with management arrogance. If you say, hey, company XYZ has this management who says he's the father of this industry, and look at this guy, he's so silly, like he wasn't involved, the industry was founded 20 years before that. I'd love to look at that. If you know of company ABC and you've got there's a CEO who says, I'm the father of this industry, and you think the stock's interesting, and you think the guy's a genius and the whole industry is about to change, I'd love to look at that. I'd love to discuss anything. You want to talk about Tom Thibodeau getting fired from the Knicks? Let's talk about it. So anyway, I mentioned that because that's why I do this. Reach out to me if you'd like to talk any of that. If you'd like, I got so much inbound on the SPACs piece. Obviously, SPACs are a long-time following, long-time love of mine, and I think they're really interesting right now. So if you'd like to talk about SPACs in any way, shape, or form, we'd love to talk to you there. But yeah, reach out. Love to talk. You can find me on Twitter. You can find my email. It's all very visible. So I think I'm going to wrap it up here. That's it for my July 2025 ramblings. Hopefully I remember to turn my microphone on. I'm looking, it looks like I remember, but hopefully I remember that. I've enjoyed talking to you. Looking forward to chatting with any piece of this that struck with you. And we will talk in my August ramblings. A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.